Welcome to i-TUTOR Economics NCERT series. Today we are going to deal with chapter 2, national income. So what is meant by national income? Do you know what is meant by national income? National income is the total value of all goods and services produced by a country in a particular period. Usually a year. Okay. So national income is the total value of all final goods and services produced within a country in a particular year. So think of it as the country's total earnings or its purchasing power. So just like your monthly salary tells you how much you can spend, the national income tells us how much a country as a whole can spend, invest and grow. Okay, so why is national income important? I will tell you one by one. First reason is that it helps us to measure economic growth. So by checking how much national income grows over time, we can see if the economy is expanding or shrinking. For example, if India's national income grows by 7% this year compared to last year, what does it show? It shows that the economy is doing better. So national income helps us to measure economic growth. Then national income is a tool for economic planning. That means government use national income to plan budget, allocate resources and make policies. For example, if national income shows agriculture is lagging, the government may invest more in irrigation or subsidies. Okay, and also national income is an important macroeconomic indicator. What does that mean? National income is a key measure of the economy's health. Economists and policymakers study to understand employment, production, consumption and saving patterns. So hope it is clear for you. Now let me ask you something. Who introduced national income? So the concept of national income was first introduced by Simon Kuznets. He was a laureate in economics. So he developed ways to measure a country's total production and income. So his work helped governments and economists understand the scale and structure of the economy. So the key idea to remember is that national income is like a thermometer for the economy. If it rises steadily, it means economy is healthy. And if it falls, that means economy may be in trouble. So it helps government decide where to spend, where to save and how to grow the economy. Okay, so now let's look at the meaning of national income. In simple terms, national income is the total money value of all final goods and services produced in a country in a year. Remember the term money value. Money value means the value at which it is sold, and final goods and services, things that are ready for consumption, is only calculated. Like a car you buy and not the steel, that means the intermediate goods you used to make it. We only calculate the final goods and services. And the period, what about the period? It usually measured in 1 year. So it is the final or total money value of all final goods and services produced in a country in a year. And what is the purpose of national income? So it tells us how rich or poor a country is and how much people in the country can consume, save or invest. Hope it is clear for you. So now let's look at some basic concepts of national income. We will cover concepts like GNP. GNP means the total value of all final goods and services produced within a country's border in a year. We will study it in detail. First, let me introduce you this. So GDP is the total value of all final goods and services produced within a country's border in a year. For example, if India produces cars, clothes and rice, the total value of all these produced in India is called GDP. So the key point is that GDP only counts the production inside the country. Remember that. It only counts the production inside the country, regardless of whether the producer is Indian or foreigner. Now, do you know what is meant by GNP? What is meant by GNP? It's the total value of all final goods and services produced by the residents of a country in a year, both inside and outside the country. For example, if an Indian company earns profit from its factory in the USA, it is counted in India's GNP but not in India's GDP. It is counted in USA's GDP and not in India's GDP, but we will count it in India's GNP. Hope it is clear. Now, what is meant by NNP? So GNP minus depreciation Depreciation means wear and tear of machines, buildings and so on are called depreciation. So GNP minus depreciation is called NNP. For example, if GNP is 100 crore and depreciation is 10 crore, then what is NNP? NNP will be 90 crores. So NNP gives a more realistic picture of income because it accounts for the loss of capital. Now what is meant by NNP at factor cost? How will we write it? NNP at factor cost, we will write it like this. NNP at factor cost. So NNP after adjusting for indirect taxes and subsidies are called factor cost. That means NNP at factor cost is always equal to NNP at market price minus indirect taxes and plus subsidies. We will study it in detail. Now I am just introducing it for you. Okay. So why NNP at factor cost is important? Because it shows actual income received by factors of production that are like labor and capital. Now what's meant by personal income? So personal income is the total income received by individuals in a country from all sources. That includes salaries, rent, interest, dividends, pensions and so on. And it excludes retained profits of companies. That means profits not paid out to owners. Now disposable income. When you hear the term disposable income, you should always remember that it is the income available to households after paying direct taxes. So the formula for disposable income is that personal income minus direct taxes. So this is the money households can actually spend or save. And per capita income. So per capita income is the average income per person in a country. What is the formula for per capita income? National income divided by total population. And why is it important? Because it helps to compare living standards across different countries. Now what about national income? So national income is the income adjusted for inflation. Real income is the income adjusted for inflation. For example, I'll tell you an example. If your salary is increased by 10%, but prices, so this is your salary and your salary increased by 10% and the prices is increased by 8%. And what is the real increase here? It is 2%. So real income shows true purchasing power. Now what is meant by GDP deflator? It's very important concept for UPSC prelims. Okay. What is meant by GDP deflator? It measures overall price levels in the economy. So what is its formula? GDP deflator is equal to nominal GDP divided by real GDP into 100. So the formula for GDP deflator is that nominal GDP divided by real GDP into 100. So GDP is the measure inside the country, GNP, residence income, NNP, net of depreciation, then factor cost is the net of taxes and subsidies. And what about personal income? It's the people's total income. And disposable income is the income after paying direct taxes. Per capita income means income per person, real income. It's adjusted for inflation, and GDP deflator is it measure price changes. So now let's look at one by one. So GDP or gross domestic product. So what's the definition for GDP? GDP is the total market value of all final goods and services produced inside a country in a given year. So remember the term final goods and services. So final goods and services means only goods or services ready for consumption are counted. Raw materials or intermediate goods like steel used to make cars are not counted to avoid double counting. So remember that GDP measures only final goods and services, and also it measures value of final goods and services produced within the country. That means GDP counts production within the country's border, regardless of whether the producer is domestic or foreigner. It counts production within the country's border. And GDP is calculated at market price. That is, GDP is usually measured at the price at which goods and services are sold. So remember that GDP is the total market value of all final goods and services produced within the country during a year, and it is calculated at market price. So it is also known as GDP at market price. So how can we calculate GDP? We can calculate it through expenditure method, income method and product method. So here let's look at the expenditure method. Okay, GDP by expenditure method. So GDP can be calculated using the expenditure method, so which sums up the total spending in the economy, where C means consumption expenditure, I investment expenditure, G government expenditure, and X minus M, that means net exports or export minus import. So what does this consumption expenditure means? It means our consumption expenditure is the spending by households on goods and services. For example, for buying foods, clothes, paying for electricity and so on. And investment expenditure means spending by businesses on capital goods like machines, factories, equipments, and also households investing in new houses. And what about government purchases or government expenditure? They are the money spent by the government on goods and services like salaries for teacher, building roads, defense and so on. Now X indicates exports, that means goods and services produced in the country and sold abroad. M means import, that means goods and services bought from other countries. So X minus M indicates net exports. Net export means export minus import. If export is more than import, it means positive net export, and if it is import is more than export, it is negative. So we can calculate GDP by calculating consumption expenditure plus investment expenditure plus government expenditure plus net export. So let's understand it with an example. Suppose in a year household spend 50 lakhs on goods. That means consumption expenditure is 50 lakh. And businesses, they invest 20 lakhs in factories. That means investment expenditure is 20. And government spends rupees 30 lakhs. So government expenditure is rupees 30 lakhs, and export is 10, import is 5. So X minus M means 5. So how can we calculate the GDP through expenditure method? 50 plus 20 plus 30 plus export minus import, that is 5. So 50 plus 20 plus 30 plus 5, that is 105 lakh. So 105 lakhs is the total value of all goods and services produced inside the country that year. So hope you understand the meaning of GDP. GDP is the total market value of all final goods and services produced within the country during a year, and it is calculated at market price, or it is also known as GDP at market price. Through expenditure method, we can calculate it using a formula, that is C plus I plus G plus X minus M, where C is consumption expenditure, I investment expenditure, G government expenditure, and X minus M is the net export. If export is greater than import, that indicates a positive growth, and if import is greater than export, it indicates a negative growth. Now net domestic product or NDP. So what's mean by NDP or net domestic product? So let's look at the definition. NDP is the net output value of all goods and services produced in a country in a year, after accounting for the wear and tear of capital. So every year, machines, factories and equipments lose value due to use or becoming outdated. So this loss in value is called depreciation. And NDP removes this depreciation from GDP to get the true net production. So NDP is equal to GDP minus depreciation. Always remember that NDP does not include depreciation. Okay. So G means gross, N means net. Gross always have depreciation and net doesn't have depreciation. So NDP is always equal to GDP minus depreciation. Okay, so GDP means gross domestic product or total value of all goods and services produced, and depreciation is the value of capital that has worn out or become obsolete during the year. Okay, let's look at an example. Suppose GDP of a country is 200 lakh and depreciation or wear and tear of machines and buildings is 20 lakh. So how can we calculate NDP? What's the formula? NDP is equal to GDP minus depreciation. So 200 minus 20. So 180 is the NDP here. So this means that the net value of production after counting or accounting for depreciation is rupees 180 lakh. So what is the key idea here? GDP is the total production without worrying about capital getting old. NDP is the total production after considering capital losses. More realistic picture or realistic measure of what the economy actually produces for the future use. Hope you understand. Now let's look at GNP or gross national product. So what is the definition for GNP? GNP measures the total value of all final goods and services produced in a year by a country's residents, including the income they earn from abroad. So what is the key difference between GDP and GNP? GNP considers income from abroad, but GDP only looks at production inside the country. So GDP looks at income from outside the country or abroad, and GDP only looks at the production inside the country. So what are the components of GNP? So what is GNP? GNP is the total measure of the flow of final goods and services at market value resulting from current production in a country during a year. It includes net income from abroad, or it includes NFIA, net factor income from abroad. So what is the equation for GNP? GNP is equal to GDP plus NFIA. NFIA means net factor income from abroad. Okay, net factor income from abroad. Net factor income from abroad means income that we get from foreign countries minus income we pay to the foreigners. That is called net factor income from abroad. Okay, so GNP is always equal to GDP plus NFIA, or GDP plus net factor income from abroad. Okay, so what are the components of GNP? C, consumption, then gross investment I, then government spending G, and also net export X minus M. These are the components of GNP2. Consumption, that means value of goods and services produced for immediate use of people. For example, clothing, food, healthcare and education. Then gross investment or investment expenditure. That means the value of investment in capital goods like machines, buildings, factories, and so on. So it includes residential construction and inventories. And what about government spending? These are the goods and services produced or purchased by the government. For example, roads, schools, defense and so on. And net export, as I told you earlier, net export means export minus import. Exports are to GDP, that means goods sold to other countries. Import, subtract from GDP, that means goods bought from other countries. And what about net factor income from abroad, NFIA? It's the income earned by residents from foreign countries like salaries, profits and so on, minus income paid to foreigners working in the country. So NFIA means income earned by residents from foreign countries minus income paid to foreigners working in the country. So what's the formula for GNP at market price? GNP at market price is always equal to GDP at market price plus NFIA. And we know that GDP at market price means consumption expenditure plus investment expenditure plus government expenditure plus net export. And plus NFIA, that means R minus P. R minus P. Okay, R minus P means income earned by residents from foreign countries is R, and income paid to foreigners working in the country is P. So R minus P. GNP at market price is equal to GDP at market price plus NFIA. So let's look at an example. Suppose GDP is equal to 500 lakhs. This is 500 lakhs, okay. It's equal to 500 lakhs. And net income from abroad or NFIA is equal to 20 lakhs. So what will be GNP at market price? It's 500 plus 20, that is equal to 520 lakhs. This means that the total income of the country's residents, including what they earn from abroad, is 520 lakhs. Okay. So GDP is the production inside the country, and GNP means the production by the country's residents wherever they are in the world. Okay. Now, net national product at market price or NNP at market price. What is meant by that? This NNP measures the net output of the economy in a year after accounting for depreciation. So depreciation is also called capital consumption allowance. Okay, so this depreciation is the value of capital goods like machines, buildings, vehicles, etc. that wear out or become outdated during the production process. So what's its formula? NNP is equal to GNP minus depreciation allowance. If GNP is equal to 520 lakhs and depreciation is equal to 20 lakhs, what will be the NNP at market price? It will be 520 minus 20, that is 500 lakhs. And this shows the actual new output of the economy, ignoring the replacement cost of old capital. Hope it is clear for you. Now, NNP at factor cost. NNP or net national product at factor cost. So what is the definition for NNP at factor cost? NNP at factor cost is the total income earned by the factors of production. It is the total income earned by the factors of production. What are the factors of production? Land, labor, capital and organization. And what are the income earned by them? For land, we are paying rent. For labor, wages, capital, interest and organization profit. So NNP means the total income earned by these factors of production in producing goods and services. So to get NNP at factor cost, we adjust the NNP at market price for indirect taxes and subsidies. Indirect taxes and subsidies. What is meant by this indirect taxes? So that taxes like GST, VAT, so they are added to prices but don't go to the producers. So we remove them. And what about subsidies? They are like government supports to farmers. They are added to producers' income, so we include them. So NNP at factor cost is always equal to NNP at market price minus indirect taxes plus subsidies. Okay. So let's take an example. If NNP at market price is equal to 500 lakhs, then indirect taxes, it is 30 lakhs and subsidies 10 lakh. So how can we calculate NNP at factor cost? 500 minus 30 plus 10, that is 580 lakhs. And this tells us the actual income received by households and firms from production, excluding taxes that go to the government and including subsidies that benefit producers. So the concepts are GNP means the total production by residents. That includes net income from abroad also. And NNP at market price means GNP, what is the equation for NNP at market price? GNP minus depreciation. And NNP at factor cost is always equal to NNP at market price minus indirect taxes plus subsidies. Okay. Indirect taxes plus subsidies is also called net indirect taxes. Okay. Remember that, NIT. Now, personal income. What is meant by personal income? So personal income is the total income received by all individuals in a country in a year before paying direct taxes. And it includes income from wages, salaries, rent, interest, profits and transfer payments. Transfer payments means one-way transaction, okay, like pensions, scholarships and subsidies. So personal income includes wages, salaries, rent, interest, profits and transfer payments. So what are the key points to remember? Personal income is not the same as national income. Why? Because national income includes profits retained by companies, that means undistributed profits, and contributions to social security like employees provident fund are also included in national income, which people don't actually receive. So personal income only includes those income which people actually receive, and this undistributed profit and employees provident fund, that things are not included in personal income. And also personal income adds transfer payments like pensions, unemployment benefits and so on, because individuals actually receive this money. So personal income is equal to national income minus social security contributions and undistributed corporate profits plus transfer payments. Transfer payments means one-way transactions. Let's take an example. If national income is rupees 1000 lakhs, social security contribution is rupees 50 lakhs, undistributed corporate profit is rupees 70 lakhs and transfer payments is 100 lakhs. So how can we calculate this personal income? This 1000 minus 50 plus 70 plus 100, that is 980 lakhs. So personal income is the actual income that individuals can receive before paying their direct taxes. Okay, now disposable income. What is meant by disposable income? So disposable income is the income that individuals actually get to spend or save after paying their direct taxes like income tax. And it is also called disposable personal income because it's the money available for disposal to the households. So from your total personal income, the government takes direct taxes and the remaining is what you can either spend, that means to consume, or save. For the formula is disposable income is equal to personal income minus direct taxes. If your personal income is rupees 980 lakh and direct tax is 180 lakh, then what will be your disposable income? It will be 800 lakhs. And this 800 lakh is what households can use for buying goods, services, or saving for the future. So how can we link it to consumption saving? Is all disposable income can be spent? No, not all disposable income is spent. Part of it is consumed for buying food, clothes, bills, etc. and part of it is saved in like in bank deposits, investments and so on. So disposable income is equal to consumption plus savings. So hope it is clear. Now let's look at the meaning of per capita income. Per capita income. What is meant by per capita income? So it's the average income of each person in a country for a particular year. And it shows the standard of living or economic well-being of the people. So if you divide the total income of a country by the total number of people, you will get the average income per person. So per capita income is equal to national income divided by total population. For example, suppose a country's national income is 10 lakhs and the total population is 50. So what will be the per capita income of that country? It is 20,000. This means on average each person earns 20,000 per year. So per capita income is an average. So it doesn't show how income is actually distributed. Even if the average is high, some people may earn a lot while many others earn very little. Okay. Now real income. So what's meant by real income? Real income is the actual buying power of your income. So it tells you how much goods and services you can buy with your nominal income after adjusting for changes in prices. That means inflation. So nominal income is equal to money value of income at current prices. And what about real income? Money value at the same money value at the base year. So nominal income is the money value of income at current price, but the price changes over time. So rupees 1 today may not buy the same rupees 1 last year. So real income adjusts for this change, giving the true value of income. So real income is always equal to national income at current price divided by national income at the base price. Suppose national income this year is 1 lakh rupees and price index this year is 125. That means base year is 100. So the real income is 1 lakh divided by 100, that is 80,000. 100 plus 125, that is 80,000. And this means after adjusting for price increase, your income can buy goods worth 80,000 in base year prices. Now GDP deflator. What is meant by GDP deflator? It is a measure of overall price level in the economy. It shows how much prices of goods and services included in GDP have changed compared to base year. And it helps us to separate the effect of price change, that means inflation, from the effect of growth in output. So the equation for GDP deflator is nominal GDP divided by real GDP into 100. So if nominal GDP is 5 lakh and real GDP is 4 lakh, how can we calculate it? 5 lakh divided by 4 lakh into 100. So this means prices have increased by almost 25% compared to base year. So real income, it shows true purchasing power of income, and GDP deflator shows how much prices have changed over time. So now we have covered different concepts related to national income, that is GNP, NNP at factor cost, personal income, disposable income, per capita income, real income and GDP deflator. So that's let's stop it today. Thanks for watching. For more related contents, do like, share and subscribe.